Hello everyone. My name is CA Ankit Jain, and today we'll be discussing on the income tax aspect on the mutual funds. So, coming to the mutual fund, there are two types of the mutual funds. One is equity oriented, and other is debt oriented mutual funds. Equity oriented are the one in which at least 65% of the total portfolio is invested, or total value is invested in the equity related instruments. So such mutual fund will be called as equity oriented mutual funds, and other than equity are called as debt oriented mutual funds. So if you just see the income tax aspect on these two, both have very different implications. So let's understand one by one. So let's understand the first one is equity oriented mutual funds. In this, we can divide into short-term mutual funds and the long-term equity-oriented mutual funds. So if the holding period, suppose you bought a share and you sold within a period of 12 months, then that will be called as short-term mutual funds. And if you sell for after a year, it is called as long-term mutual funds. So if you just say taxation part, they are taxed at the straight away at the rate of fixed 15% on the profit. So let's say if you bought a mutual funds in the month of January, for rupees 1 lakh and sold the same in the September. So as it is holding period is less than 1 year, so that will be termed as short term mutual funds, and the taxation part will be 15% of the profit, that is 20,000. So the value will be 3,000. So in case of long term, the taxation is 10% over and above the profit of rupees 1 lakh. So let's say like if you bought a mutual fund in Jan 2019 of rupees 1 lakh and sold the same in March 2024. So as it is more than 1 year, it is called as long-term mutual funds, and the profit or other and the profit is rupees 1 lakh 60,000. So the tax will be over and above rupees 1 lakh. So the tax will be only on 60,000. So 10% of 60,000 will be 6,000. But if you come to the debt-oriented mutual fund, the taxation part is very different. So in this case also there is something called a short term and something called as long term. But here holding period is 3 years and not 12 months. And if you hold for less than 3 years, it will called as short term. If you hold for more than 3 years, it's called as long term. So the tax rate is according to the slab rates. So whatever slab rate you are following or you are falling in, that will be applicable. Suppose let's say if your income is less than 3 lakh in the new tax regime, there is no tax. And if you're more than 8 lakh, it will be 10%, 15%. So different depends on the slab rates. However, in the case of long term, the tax rate is 20% with the indexation benefits. Okay, so let's say for example you bought sorry, it's not an equity, it should be treated as a debt oriented mutual funds in the month of Jan 2019 for rupees 1 lakh and sold the same in March 24. So as holding period is more than 3 years, it is called as long term mutual funds. However, in this case, the actual cost will not be rupees 1 lakh. We have to provide an indexation benefit. So the indexation CII index will be released by government every year. Uh, so here is the CI index, which is, so in case of Jan 2019, the CI will be is 280, and for sale 2024 will be 348. So if we just see, uh, so the revised cost will be 1 lakh divided by 280 into 348, which will come to 1 lakh 24 286. So this is the index cost of acquisition. So in this case, the profit will be 2 lakh 60 minus 1 lakh 24, which will be 1 lakh 35. And on this, 20% is taxable, which is rupees 27,143. So that's how the concept of mutual fund is. So if you have any queries or